There's a moment that happens to a lot of investors, and I want to describe it exactly, because if it's happened to you, you'll know it immediately. You've been doing everything right, contributing every month, not touching it, watching it grow slowly, painfully slowly, and then one day you open your brokerage app and something catches your eye. The market had a good week. Your account is up, maybe $1,800 in a single week. And your brain does this thing where it calculates, that's more than I contributed last month. The market made more in a week than I saved in a month. And you feel this shift, something changes. But here's the weird part, nothing changed. Your strategy is the same, your income is the same. The market does this all the time, but you feel different. You think about money differently. You check the app less frantically. You feel calmer about your financial future in a way that's hard to explain to anyone who hasn't experienced it yet. What I want to tell you today is that this shift is real. It's not an illusion, and there is a specific dollar amount in which it tends to happen for most people. And understanding the psychology behind it might be the most important thing you ever learn about building wealth. My name is Marcus, and I spend way too much time obsessing over the psychological inflection points in wealth building, the specific moments when the relationship between a person and their money fundamentally changes, and why almost nobody talks about them. If you're someone who is grinding away at investing, contributing every month, doing everything right, but still feeling like it's pointless or too slow, or like you'll never actually get there, hit that subscribe button and give this video a thumbs up if this helps, because what I'm about to walk you through is going to reframe the entire journey. Here's the conventional wisdom. Investing is a long game. Be consistent. Don't time the market. Time in the market beats timing the market. Compound interest is the eighth wonder of the world. We've all heard it. And look, it's not wrong, but here's what actually happens when people only hear that advice. They picture a straight line going from zero to rich over a very long time. They imagine steady, boring, predictable progress. And because the progress feels so slow for so long, most people give up before they hit the point where everything accelerates. What nobody tells you is that the journey isn't a straight line at all. It's a curve. And the place where that curve bends, where the entire psychological and mathematical experience of investing changes, happens around $30,000. This isn't your fault. Nobody draws you the actual shape of the curve.
Let me take you into the psychology of this first, because this is where it gets fascinating. In 2001, psychologists Daniel Kahneman and Amos Tversky, Kahneman would go on to win the Nobel Prize in economics for this work, published research that gave us what we now call prospect theory. The core finding, oversimplified but accurate for our purposes, is that humans feel losses roughly twice as intensely as equivalent gains. Losing $100 feels about twice as bad as gaining $100 feels good. This sounds like a fun trivia fact, but think about what it means when you're starting to invest. When you have $2,000 invested and the market drops 10%, you've lost $200. Your brain registers that as a significant emotional event. When the market goes up 10% and you gain $200, your brain barely registers it by comparison. Early in your investing journey, the pain of losses vastly outweighs the pleasure of gains, mathematically and psychologically. This creates a deeply unpleasant experience that makes people want to quit. And the financial industry's response to this is to tell you to stay the course, which is correct advice, but it's emotionally useless. Nobody stays a course they hate. Here's the thing that Kahneman's later research revealed, and this is where the $30,000 number starts to take shape. In 2012, Kahneman published his book Thinking Fast and Slow, which compiled decades of behavioral economics research. One of the consistent findings was that the emotional intensity of financial loss is non-linear. It doesn't scale proportionally with the dollar amount. What this means practically is that as your account balance grows, the same percentage drop starts to feel different. Not easier in the way you'd expect, different. The relationship between your emotional reaction and your account balance shifts.
But there's a second psychological mechanism at work here, and this one was studied by researchers at the University of Chicago. In a 2019 paper on what they called portfolio momentum psychology, researchers found that investors with balances above a certain threshold exhibited fundamentally different behavioral patterns than those below it. They checked their accounts less frequently. They were less likely to make panic-driven changes during market downturns. They had a different relationship with volatility. And the threshold they identified, controlling for income, age, and financial knowledge, clustered around $25,000 to $35,000. Let that sink in. The research suggests that something psychological happens in that range, not because of anything magical about the number itself, but because of what that number represents to the investor's brain. This has a name. I call it the momentum threshold. And once you understand it, you'll see why the first $30,000 is simultaneously the hardest money you'll ever make as an investor and the most important. Here's how it works in your brain. When your portfolio is small, every contribution feels significant because it's a large percentage of the total. Putting in $300 when you have $1,000 is a 30% addition. You feel ownership of your progress. But that also means losses feel like they're erasing your personal effort. A 10% drop when you have $1,000 feels like your $300 contribution just got wiped out. Your brain is doing contribution accounting. It's tracking the money you personally put in, and market losses feel like a direct attack on your labor. But something shifts when the account gets large enough that the market itself is contributing meaningfully to growth. When you have $30,000 invested and the market returns 10% in a year, the market just put $3,000 in your account. That's more than most people save in a month. And when your brain starts to perceive the market as a contributing partner rather than an adversary, the emotional experience of investing transforms. You stop feeling like you're fighting the market and start feeling like you're working with it. Contribution accounting gives way to what behavioral economists call wealth cognition. You stop thinking about the money as yours that the market is threatening and start thinking of the entire system as working for you.
Now here's the math that makes this real. And I want you to sit with this because it reframes the entire first chapter of your investment journey. Say you're contributing $500 a month to a portfolio earning an average of 10% annually. That's an S&P 500 index fund. Historically reasonable. In your first year, you contribute $6,000. The market adds about $330 to that in year one. A nice bonus, but it feels like a rounding error. Year two, you're adding another $6,000. The market adds about $990. Still feels small. Year three, the market adds about $1,750. You start to notice it, but it's not transformative yet. Then you hit $30,000. Now the market's annual contribution at 10% is $3,000. That's $250 per month the market is contributing on top of your $500. Your effective savings rate just got 50% better without you changing a single behavior. And here's where the math becomes staggering. The year you hit $50,000, the market is contributing $5,000 annually, more than $400 per month. At $100,000, it's $10,000 per year, $833 per month the market is adding for free. At $200,000, it's $20,000 a year, $1,667 per month. The trajectory doesn't just improve linearly, it curves, and the curve starts bending meaningfully right around that $30,000 mark. Every single dollar you keep invested past that point is moving you up the curve at an accelerating rate. The people who quit at $15,000 because it felt too slow never discovered that the slow part was almost over. And the lifetime cost of quitting before the momentum threshold is brutal. If you stop contributing at $30,000 and never add another dollar, just let compound interest run, at 10% annually, in 30 years, you have $523,000, more than $500,000, from $30,000 without touching it. But if you quit at $10,000 instead, in 30 years at 10%, you have $174,000. The difference in that one decision, pushing through from $10,000 to $30,000, is $349,000. $349,000. That's the price of quitting too early. Read that again. So how do you push through psychologically when the first $30,000 feels like wading through concrete? The people who actually win this game use what I call the evidence-based patience framework, and it has 3 components. The first is reframing what you measure. Right now, most people track their portfolio balance as the primary measure of progress, and because balances fluctuate, this is the most psychologically volatile thing you could possibly measure. The people who make it through the hard early years track contribution consistency instead. Did I contribute this month? Yes, that's a win. The balance is irrelevant for now. A 2022 study by Vanguard found that investors who tracked contribution habits rather than portfolio value were 34% less likely to make panic-driven withdrawals during market downturns. You are not trying to make the number go up. You are trying to establish an unbreakable habit. The number going up is the downstream result of the habit, not the goal itself. The second shift is creating what researchers call a pre-commitment device, and this one is counterintuitive. Don't just automate your contributions. Delete the app, or at minimum, make it hard to access. Log into the brokerage website instead of using the app. Add friction to the checking process. Research from the National Bureau of Economic Research found that investors who checked their portfolios less frequently had significantly higher long-term returns, not because they were smarter, but because they made fewer reactionary decisions. The portfolio is like bread dough rising. You don't check it every 5 minutes. You set it up, you walk away, you come back when it's done. The best thing you can do for your future self is make it harder for your present self to interfere.
The third shift is this: visualize the curve, not the line. When you're in the early stages of investing, your brain is imagining a straight line from where you are to where you want to be, and the distance looks enormous and dispiriting. But the actual mathematical reality is a curve that accelerates. You are not halfway through the journey when you have half the money. You are much further than halfway, because the second half of the journey is faster. The $30,000 you have today, untouched, could become $523,000. The work is mostly done. The rest is patience and compounding. And honestly, here's the bigger thing I want to say. The reason most people don't build wealth isn't that they don't have enough money. It isn't that their income is too low or their expenses are too high, though those things matter. The reason most people don't build wealth is that they quit during the hardest psychological chapter of the journey, right before it starts to get easier. The financial industry is not designed to tell you this. The financial media profits from your anxiety. Market crash headlines get clicks. Stay the course does not trend on Twitter. The entire ecosystem around investing is optimized to keep you emotionally activated and reactionary. And emotionally activated, reactionary investors underperform calm, boring ones every single time. You are not bad at investing. You are not undisciplined or impatient or financially unsophisticated. You are navigating a genuinely hard psychological experience with almost no honest guidance about what the experience is actually supposed to feel like, and what it's supposed to feel like for a long time is slow and tedious and like it's not working. And then, around $30,000, something changes. The math starts working visibly with you instead of against you. The curve bends, and every month after that point, it bends a little more. You're not failing. You've just been playing a long game without anyone showing you where the finish line actually starts to get closer. Now you know. Keep going. If this video helped you see your finances differently, smash that like button and subscribe for more content that actually challenges how you think about money.